Okay guys, welcome back. Here it is, the video you have all been waiting for. I've literally had thousands of requests for me to make this video, so I've made it just for you. So as always, I've done a huge amount of research so that you don't have to, with the added benefit, I've been in the real estate sector for the last 15 years. I'm an investor, I'm a landlord, I have a huge rental agency, and I have a training academy with students from all around the world, from the United States to Europe to Australia. So I've seen a lot of YouTubers commented on the housing market over the last few weeks, and I really had to bite my tongue and not say anything because a lot of the data they're using is from Fannie Mae and Freddie Mac, which literally has me spitting out my English tea. Of course, they're going to be giving you all these optimistic forecasts of growth this year. They're biased. Of course they're going to say this. And the funny thing is, I've not seen anything in the media from Freddie or Fannie in a long time, nothing. And yet all of a sudden, the media's putting out all this data and all these articles on what Freddie and Fannie are saying. And if you don't know who Fannie Mae and Freddie Mac are, they're like the biggest loan mortgage operators in the United States. But with all this data coming out from them, you know what it reminds me of?
Then you don't need us to tell you that gas prices are back on the rise.
You don't need us to tell you that gas prices are back on the rise.
You don't need us to tell you that gas prices are back on the rise.
You don't need us to tell you that gas prices are back on the rise. You don't need us to tell you that gas prices are back on the rise. You don't need us to tell you that gas prices are back on the rise.
You don't need us to tell you that gas prices are back on the rise.
So if you're a subscriber of mine and you appreciate the hundreds of hours, yes, hundreds of hours, and the 6 weeks and thousands of data points that have gone into making this video for you, please hit the like button below for me right now. I really appreciate it. Thank you so much. And remember to make comments as well as you go through the video. Thank you. Okay, with that said and the like button clicked, I hope you've done it, let's get into the content then. Between 2006 and 2009, home prices dropped by 35%. This was the biggest drop we've ever seen since the Great Depression. Home prices have always historically been about 3 to 4 times median household income. It's always been like this. But then in December of 2005, it actually jumped up to 5.1 times median income before crashing. This ratio is still high, it's about 4.4 times median income, which was unheard of prior to about mid-2004. And if you're watching this video outside of the US or Canada, in your country this is probably called the PE ratio, which stands for the price per earnings ratio. Or more simply put, it's the price of a house versus your annual income. So let's say that you earn 25,000 and you want to buy a house for 100,000. That means the ratio would be 4 to 1 for you. Next, and this is a big one, it's reported that over 30% of tenants did not pay their rent in April. So the 1st of April payment, 30% of tenants actually missed that payment. Another statistic, over 2 million people requested mortgage forbearance towards the start of April. This is huge. In the last month alone, more jobs have been lost than have been created in the last decade. Even trying to get a grasp on the unemployment figures is staggering. But Shadow Stats, which is an alternative government agency, puts unemployment at 22% as of mid-April. Unbelievable. This is the highest climb of unemployment in history. If you just look at the chart, you can see it's a vertical line going straight up. And this is important because housing crashes are usually caused by 2 distinct things. Number 1 is unemployment, and number 2 is higher interest rates. Again, we're going to come on to this shortly. Wages in the United States have climbed very, very gradually versus an explosion in housing prices. Now you compare this to other countries, and I'll give the UK as an example. Wages have remained flat. They've pretty much stagnated, yet property and houses have just exploded in value. Where in London, you ready for this? We had a 13 to 1 price per earnings ratio on a house. So you might think you've got it bad with 5 to 1. Go to London, it's 13 to 1, which can only mean one thing for everyone, and that's more debt. I mean, just do the math on this, guys. How can someone earning 30,000 per year get a mortgage on a $250,000 house and drive a 60,000 car or truck? Have you ever stopped to think about that? That makes absolutely no sense. So let me just give you some context around this, and we'll go back prior to 2008. And we'll talk about the housing crisis and how there's a lot of misinformation around this. The banks get the brunt of the blame, but there's actually another party who people don't ever talk about who's also to blame in this. So the banks were basically gambling with yours and my mortgages. They were packaging them up in bundles of thousands of mortgages, and then they were selling them to investors in something called a CDO, which basically stands for Collateralized Debt Obligation. Then they were hedging these bets, these gambles, by getting insurance by huge insurance companies like AIG. However, because these big insurance companies thought there was no chance of a housing crash or a decline ever occurring, they simply didn't keep the cash they were supposed to keep on reserve. So they had no cash, they had no liquidity to actually meet all of these claims when it came to it. So they needed to get bailed out. So they had a huge bailout. So the government then stepped in, as well as regulators, to make sure that this would never happen again and that a CDO would never be created again. But guess what happened in 2015? The CDO got rebranded, shall we say, under another name of a BTO, which is a bespoke tranche opportunity. I'm not making this stuff up, guys. You can look this up. Last time around, it was the shadow banking sector that caused the collapse, in my opinion, and I believe that they're going to cause it again this time around, because although the shadow banking sector is not supposed to be loaning the way they are, that's actually been happening for a long time. And if you're sat there wondering what on earth is the shadow banking sector, it's basically private institutions, so they're not banks, who lend money to people for mortgages. And it's said that 5 of the top mortgage lenders now, so this is 60% it accounts for, of all mortgages are not from banks. They're from the shadow banking sector. And so as much as I don't agree with huge government interference into business sector, I do think that the government needs to regulate the shadow banking sector a lot more strictly to make sure that they are not doing these bad loans. And just to give my opinion on this, I personally don't think that the banking sector should be allowed to gamble the way they do with these CDOs or BTOs, whatever you want to call them now, and get insurance against their hedges, their bets. I think that's wrong. So let's hear from Fannie and Freddie then on what they think is going to happen to housing prices in 2020. Fannie Mae is still projecting the median price for an existing home to rise to $275,000 in 2020 from $272,000 in 2019, while the median price for a new home is expected to increase to $326,000 from $321,000 in 2019. A little bit suspicious if you ask me. I've also just seen today an amazing proposal, so generous, from Freddie and Fannie, offering to buy up any houses that fall into forbearance. Wow, isn't that kind of them? And if you've been watching my other videos, you know exactly what's going on there. Ginnie Mae is another one you may or may not be familiar with. They basically underwrite all the mortgages for the shadow banking sector. Although it's quite difficult to get accurate stats right now, we personally believe that the forbearance request through Ginnie Mae loans is at 6% at the absolute minimum. I personally believe it's a lot higher, but we know it's at 6% for sure. Ginnie, Fannie, and Freddie, all one big happy family. Here comes the next problem. Do I sense deja vu? We saw it announced last week that the FICO score's now up to 700, and you also need a 20% down payment. So that's a deposit on any houses. This is crazy because I'll tell you exactly what's going to happen. It's the same thing that happened in the 2008 crisis. A lot of people are going to be coming to the end of their standard variable rate mortgage right now, and they're not going to be able to refinance, especially with house prices dropping. I can assure you of this. So let's say you got a really good mortgage and then you were told by your broker that you can definitely refinance at the end of the term. Right now you're coming to refinance. Oh wait, it's 20% down. I've only got 15% or 10% equity in my property because I got a 5% down loan. So now you need to find that extra 15%, or let's just say it's 10% now because you've paid off a little bit. How are you going to find that extra 10%? And you know, with average house prices, you need to find what, maybe 25K? How are you going to find that extra 25K? Which means those people's interest rates are going to go through the roof. Payments are then going to go up. And you know, I know the statistics. Most Americans spend 100% of what they earn. So now you have these higher payments and they could be a few $100s more expensive. and people are going to start going into debt. At a time when unemployment is going through the roof, there's less money around, this is going to be a big problem, ladies and gentlemen. And also with the 700 score and 20% down, the other thing this is going to do is it's going to stop first-time buyers or anybody who is looking to get a new home who simply doesn't meet that criteria. So you're now pulling this big chunk of people out of the market who are going to buy. So you're now decreasing the supply of buyers in the marketplace. This is another thing that causes prices to go down. And this is the same in any industry. When you've got more buyers out there, the sellers can ask for more. They can increase their prices. But when you've got less buyers, the sellers have to decrease their prices. And guys, if you haven't clicked the like button for me, please do that for me now. I really appreciate it. It helps my video to get ranked in YouTube. So thank you so much. And as I said in my mortgage apocalypse video just the other day, if you haven't seen that, watch it. It's about 250,000 views now. The biggest risk to all of this is human beings. Because what happened in the last crisis, people start to drop their house prices, whether that's 5, 10 or 20,000, just so they can get theirs sold, priced more competitively to other houses in the area. But then what happens is the agent sees that and they say, oh, I think we should drop yours. If you desperately need to sell it, I think you should drop yours because that house down the road there, they've also dropped theirs. So we need to be more competitive. And what it does, it creates this negative spiral with everybody doing it, trying to sell theirs before the big crash happens. And one point I do need to cover, because I didn't cover it in the mortgage video, is inventory. So what this means is the amount of houses on the market and the month's worth of supply available. So in some places where you've got more than a 6 months supply, you're probably going to see a massive decrease, much more than places where there is only, say, a 2-week supply. So I have a friend, many of you might know him, he's a famous realtor in California, and he was saying to me that there's only about 2 weeks worth of supply in certain areas like Los Angeles County. So in places like this, people are stupid with money, right? They will pay anything for a house because when you've got all the money in the world, you don't really care how much your house is going to cost. So in these areas, because there's so little inventory and supply, they'll probably, I wouldn't be surprised if they carry on going up in value. I really wouldn't. A lot of people simply don't want to put their house on the market right now, or they're actually pulling their house from the market. So this is decreasing supply as well, and this will help to hold up prices, because who wants someone coming around their house coughing, maybe spreading on the virus to your family members? No one. So this is also this is what I'm saying is all these things combined are affecting the housing market and the prices. And one of the other problems that I can see at the moment is that the government has allowed people to just take forbearance without having to prove any financial difficulty. This, in my opinion, is a huge mistake, because human nature being what it is, a lot of people will simply take the forbearance just to give themselves some extra cash. A lot of people are doing this already. We've seen it, over 2 million forbearance claims. So next point, this is not going to come as a surprise to any of you. Do you remember what happened in the 2008 recession? Who bailed out the banks? Who bailed out the insurance companies with the hundreds of billions? You know who it was? It was the government. And guess what? The government doesn't have any money. The government doesn't make any money. The money comes from either the Fed through printing, which is a loan, or it comes from taxing. So really, it's the citizens that pay for the bailouts. It's not the government, it's the citizens through our taxes. We're the ones that pay for the bailout. This is why I was so infuriated the last time for all of these bailouts. It's just not right. And guess who's going to pay again this time? Because again, the insurance companies, but more importantly, the banks, haven't got the cash reserves on hand. You can tell just by looking at the media stories where all these CEOs of the banks are insisting on meetings with the government to get this bailout money. Why would they need bailout money when they're the banks? Why would they need cash? I'll tell you why. It's because of something that passed very secretly back in March while the coronavirus was going on. And this was a change to the fractional reserve banking regulations. So just do a search for this, you'll find it quite easily. Banks no longer have to keep any reserves, so it's now 0% of cash under the fractional reserve banking rules. So let's say that you put 10,000 in the bank, so you save this money, you put it in the bank. You think your 10,000 is in the bank? It's not. They are now allowed to lend out 100% of your money. And this is why I think the banks in the US have got a massive risk coming up of people that might make a run against the banks once they start to find out about this 0% reserve. So let's just come back briefly to the whole 700 score 20% down, because the media has given a lot of misinformation around this, saying that the risk is due to unemployment. That's actually not the reason at all. The reason, and this is the true reason, is because the banks, like I mentioned, they bundle up these mortgages and they sell them on to investors. Now, investors are getting scared and they're pulling their cash and they're selling stocks and all the rest of it. So the banks know they can't sell these mortgages on easily. So what they're doing is they're increasing the score and the down payment so that it's a more secure investment for these big investment firms. And by the way, these investment firms, they include pension providers, by the way. So a lot of your pensions are probably in real estate, which is a big risk. So this raises the question, if banks are now doing this, so they're doing what they should have been doing in the first place, 700 score, 20% down, this is safe, we all know this, it keeps the housing market propped up and secure. What have they been doing for the last 5 years? And more importantly, and more worryingly, what has the shadow banking sector been doing for the last 5 years? The next thing we need to factor in is inflation versus house prices. So here's a crazy thought. House prices could actually go up in value, or they could stay stagnant. But this is an illusion. It's a trick, so don't be fooled by it. Because I'm expecting inflation to rise by an absolute bare minimum of 5% this year. If we saw less than 5%, I would be absolutely shocked. But I think, honestly, we'll see probably 10% or higher in inflation this year. So what does that do to house prices? Well, it artificially inflates them, making you think they're worth more than they actually are. And this doesn't even take into account quantitative easing, which is basically money printing. When you factor this in with the inflation, goodness me, we are really in a hole. And if you're a subscriber already, you're going to get that video that's coming out on inflation in the next couple of weeks, the next few weeks. And if you're not a subscriber, I would highly recommend you click the button below and subscribe. That way you're going to be able to get access to all of my data and all of my videos, which are very different to what you're hearing in the media. So you might be wondering then, what have the banks and the shadow banking sector actually been offering on mortgage rates then? Well, you could get a mortgage even if you had a 550 score or less. And this is the most shocking thing. Some have allowed a 3% down payment. Yes, 3% with a low credit score. This is the big bubble that is about to burst. So let's wrap all of this up then and let's come into the final predictions. Due to the highest spike in unemployment ever recorded in history, I think the market could correct to as much as 40%. I don't think we're going to see less than a 15% correction, but if we saw 40%, I wouldn't be surprised at all. But if the government steps in with all their programs, with Fannie and Freddie as well, offering to buy all the houses that go into forbearance, this is simply going to kick the can down the road. It's not going to change anything. Because what do you think the government or Fannie and Freddie or the Fed or all these banks who own all these houses are going to do with them? They're not just going to keep them, they're going to do something with them themselves. So this is going to have a knock-on effect further down the road. But again, in some bubble areas, we're probably not going to see much of a change in prices, simply because people don't have an option. When they're earning very high incomes, like let's say San Francisco, for example, or maybe LA, they need to live somewhere, so house prices are going to be propped up by the job markets there. So are we going to the biggest housing crash on the history of our planet? Well, based on how the next 3 to 4 months play out, it's definitely possible. Something has just been announced as well this week, which is that the government is offering to pay all the rent payments and all the mortgage payments of everyone for the next 12 months. That's crazy. Again, where do you think this money's coming from? The government doesn't have any money. They're covering trillions of dollars in deficit. This is not going to end well. So guys, thank you so much for watching my video. If I've helped you in any way today, please return the favor by clicking like on the video below. Make sure you're subscribed if you're not, do that now. And just leave me a comment below. Let me know what you thought of the video. And also let me know if there's any other videos that you would like me to make just for you. Thanks so much. Take care guys, stay safe, and I'll see you next week with another video.